The market is hitting record highs, but in some sectors, valuations are stretched. So how do you find high quality growth without overpaying? Joining me now is Alex Hoy from GQG Partners. He joins me at the desk. Great to have you.
Oh, thanks for having me.
So we hear this word quality thrown around a lot, but tell us, what does it mean to you? What's the one really key metric that matters most to you?
Yeah, it's an interesting question because there really isn't just one metric. And when we are looking for quality companies at GQG, we're really assessing companies on a forward-looking basis, looking for forward-looking quality characteristics that they may be exhibiting. And what this means is, what are the skills, the attributes, fundamentals, of course, that they are exhibiting right now that may be supportive of compounding their earnings on a go-forward basis. And so getting back to the heart of your question, finding these high-quality companies without overpaying today, that's really been the challenge. Because a lot of the companies that are doing well from a share price perspective are certainly ones where we feel their valuations are stretched. And so we are avoiding many of them, many of the Mag 7 companies that we all know well. And instead, the companies that we're looking for, and this is across all periods, not just right now, we're looking for companies that can achieve a high single-digit to a low double-digit total return. And we still feel there are plenty of high-quality companies out there able to do that at much more reasonable valuations.
So that's where your ETF comes in, ETF Spotlight, GQG US Equity ETF, GQGU. Your top holding is Philip Morris, followed by Progressive and Cigna. So why is a tobacco giant a higher quality name than the Mag 7, if you will? I didn't even see any of the Mag 7 in your ETF.
Yeah, and that's right. And so thinking about Philip Morris, for an example, we've owned Philip Morris for quite some time, and we've owned it in the past. We own other tobacco companies in our GQGU strategy, which is our U.S. equity portfolio in the past. But what Philip Morris is exhibiting right now, it's a real growth trajectory away from traditional cigarettes or traditional combustible products. They're now selling, newer products, call it the heat not burn, call it the pouches. They have specific product lines here that are real drivers of growth for this company going forward. So much so that from a revenue perspective, a little over 40% of their revenues lately are now derived from these newer products as opposed to traditional cigarettes. So on a forward-looking basis, this is a totally different company than what it was in the past, giving us a lot of conviction to put it at a higher weight in our portfolio today.
I also mentioned Progressive and Cigna. What are some other names in there that might surprise us when it comes to high quality growth?
Yeah, Progressive and Cigna, so other insurance companies or MCO companies, we have a few of them in the portfolio. We also have some utility companies in the portfolio too. Quite a few names and roughly, let's call it 20% of the portfolio. These are boring companies for all intents and purposes. But what do they offer? They offer earnings stability. They offer earnings visibility due to the regulated nature of many of these companies. The regulated utilities are where we are focusing more so than some other areas. That gives us more certainty that they're going to achieve this earnings growth on a go-forward basis out over the next 3 to 5 years. And that's the time period that we assess every business in which to own. And just given the way that they operate with their regulatory oversight, their rate base that they can charge, the certainty is much higher for us today than some of the Mag 7 names that you alluded to.
We've leaned on big tech for so long to really drive this market higher. Is there still quality in those names, though?
There are. There absolutely are. And by not owning any of the Mag 7 or other tech companies, we're not saying that their fundamentals are broken or the companies themselves are broken by any means. We just don't see the earnings visibility out over the next few years with the degree of certainty that we need or that we see in other areas. And we also feel that valuations are pretty stretched in many of those places today. And we know underlying a lot of this tech trade is AI. And we are believers in AI internally, but we don't see AI being monetized yet in ways that would be supportive of some of the hopes and the expectations that have been built up for these Mag 7 companies. And that's what we need to see. We're not going to invest, based on hopes and prayers. We're going to invest based on the fundamentals as we see them.
So a diversified approach with your ETF, but it feels defensive to me. So does that mean that you're expecting the market to not sit at highs or make new highs this year?
So we haven't been shy about saying that we believe we're in an AI-driven bubble right now. So we do feel that there's a very big risk of multiple compression on the horizon. When that happens, whether it's tomorrow, 3 months from now, 6 months from now, we don't have an answer for that, but we're preparing for that outcome. And that's part of our investment philosophy. We aim to protect when times get tough. We also aim to keep up in those upmarket periods, make no mistake, but we've really protected well for our clients over the long term and generated a substantial amount of our returns by doing that, by doing so. And so our positioning right now is a reflection of the opportunity set as we see it, that we believe in a difficult environment that we do believe is on the horizon will be a portfolio that will protect well and lead to success over the long term.
If AI is a bubble, what happens when it bursts? What does that look like?
Anyone's guess. And for what it's worth, I think we'd be foolish to say even our portfolio wouldn't sell off even a little at the beginning. But given the earnings stability and visibility of the businesses we own versus ones that we feel might pop, we feel that the earnings certainty will shine through and there should be a higher floor for our businesses as a result.
What's the bigger risk, missing out on the next leg up or overpaying for what's already happened?
Yeah, well, we've missed out on some of the legs up lately, which has been disappointing. We feel very strongly about the reasons why, the fundamental reasons why we haven't been there. So at this point, certainly valuations feel like more of a concern because if you are buying in today, say you didn't have an allocation either to a typical growth portfolio or even the S&P, you're buying at peak valuations in many ways. If you're looking at price to earnings, price to sales, price to book, on a historical basis, right now the market is in the top decile of historical expensiveness. So putting your money to work right now is a real risk, in our opinion, of that multiple compression coming back and hitting you in the face. Said differently, to buy now, you really have to believe that there is further room to run and for these businesses to grow into these valuations in ways that we really haven't seen historically.
Putting money to work is a risk at these valuations in any part of the market, or are you just talking about in the high-flying AI names?
Yeah, certainly in the high-flying AI names, but even if you look at the S&P itself right now, roughly 50% of it is in TMT-related tech companies, so mainly tech and tech-related businesses. That's a level that's never been seen before. So I'm kind of saying both at the same time because it's AI that we feel is very, very expensive or rich, but that's also what's driving the S&P itself.
So how much of your portfolio should be focused on high quality growth?
All of our portfolio is. We're just willing to find growth in different areas. So we're not bound to the traditional style box labels of growth or value on the other side. We're looking for forward-looking quality companies. And these are companies that are growing their earnings no matter the economic environment we're in, if we're in a good environment or a bad environment. And so our definition of growth is a bit different than some others, but our portfolio holdings are very much growing right now.
So just to wrap things up, what's your best advice to investors as they see the market sitting at potentially even higher highs, and as they maybe have a little bit of FOMO about not chasing the momentum?
Yeah. Well, I'm not in the business of offering financial advice. I don't want to run afoul of anyone there. But if I was looking at my own portfolio after seeing a very large run up in the S&P last year, I would be wondering if it's time to shift out of the high-flying growth names and put some money to work either more defensively or simply just take money off the table from areas that feel like there is that valuation risk and also fundamental concerns in our opinion. So revisiting your allocations, revisiting your portfolio, I think would be the best step at this stage.
Okay, we'll leave it there. Alex, really appreciate your insights. Thanks so much.
Thank you.
That's Alex Hoy from GQG Partners.